Gabriella, what's your take on the likely returns for U.S. equities for the rest of this year?
Well, we do expect a bit of a consolidation here in September, October. There are a lot of issues that need to be resolved around whether the supply-driven slowdown is something that is indeed just temporary. For that, we'll have to see what happens with COVID cases, what happens with the jobs market, what happens with supply disruptions, and what happens in Congress during the month of September. Ultimately, we do still think that growth remains above trend for another 3 quarters, that earnings revisions will be able to continue to move higher, and as a result for the market to grind higher over the next year and the next few years, right, during this cycle. But I think for the next couple of months, certainly we do expect a bit of a consolidation and maybe some volatility.
Yeah, Josh, I want to get your thoughts. I know we were talking earlier about the broader market, but on some of the specific names that you've been invested in as well, just given the fact that we have seen some volatility when you dig down below the surface.
Well, I mean, look, I've been in the FANG names. I think 3 out of 5 of them I've been talking about all year long. Amazon's the laggard, but look at a chart of Alphabet. Just spectacular performance. Apple, speaks for itself. What's going on with these stocks is very simple. You really are not earning anything in your bonds, and people are increasingly looking for ways that they can have their money at work in this environment and not taking what they perceive to be economic risk. And one of the things that these companies have been able to do is really triumph over even the concept of there being an economic cycle. Like, we've had GDP fluctuation over the last 10 years, but these companies have had virtually no earnings fluctuation. Not even during a pandemic have their earnings been impacted. And in fact, you can make the case that for some of them, it actually helped. So these are the types of trades that have been working. I see no reason to overthink things. I continue to remain in these stocks, talk positively about these stocks. At a certain point, it won't continue. But so long as the Fed is putting $875 million every hour to work in the bond market, I see no reason why companies with great balance sheets, high earnings growth, good dividends, good shareholder buybacks, strong competitive positions, et cetera, shouldn't continue to prosper. And that's exactly what's going on in the NASDAQ 100, in the S&P 50, however you want to look at it.
Gabriella, what are you doing with bond holdings at the moment?
So for us, I think we've lost some conviction in terms of the exact timing and speed with which bond yields will resume their march higher. But the direction of travel is still upwards for us. So we're still very much in a danger zone for fixed income, whether it takes us a year, year and a half, 2 years. In our view, bond yields should really be much closer to 3% in a normal economy. We're still talking about then doubling the level of the 10-year and going through a period of a bear market for core fixed income. So for us, still being a little bit underweight duration versus the benchmark, thinking about areas of the market that have perhaps more credit risk but less interest rate risk, like high yield and securitized debt, which also have great fundamentals given above trend growth and a solid consumer. So still danger zone and still overall underweighting fixed income versus risk assets.
Mike, what is the Russell 2000 signaling right now, especially on a day where it ended 1.1% lower?
For the rest of the year, I think you would have to just look at the way probabilities set up when you've had a year that's been like this, which is low volatility, few pullbacks, big gains racked up in the first 8 months. Typically, the high for the year has not happened by the time you get to September in those types of years. Now, something can change. The big exception to all these things I'm going to say is 1987. I don't think we're in a 1987 mode. So it seems as if you probably make more net progress in the context, though, of a mid-cycle slowing down, probably, of returns, where it gets a little bit more selective in terms of what types of stocks work and what don't. I don't know if that's all going to come, rushing up by the end of the year, but that's the broad context.